This is a video on the Polaris Trade Management System TMS Spreadsheet. It is brought to you by PolarisInvesting.com, a site for creating defensible valuations. Recall, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. To access this video, take the YouTube link on the PolarisInvesting.com website that takes you here, and then at the bottom, select the Polaris TMS app playlist. Or you can view it directly from the spreadsheet by selecting the user's guide link. In this video, we'll be discussing three things. Why was the spreadsheet created? How do you get it? And then navigating and using the spreadsheet. So why was the spreadsheet created? Its primary purpose is to provide a disciplined stock trading approach where the objective is to be less wrong in making investment decisions with an uncertain future, whether a person is a long-term value investor or a short-term speculative trader. At some point, they trade stocks. Now, the spreadsheet could be configured to just record trades all the way to suggesting trades. Suggestions are based on user-selected cumulative price change and cash balance thresholds when buying and selling. In the short term, stock returns often vary wildly, raising the possibility of ill-timed trades. Thus, it is important to manage trades to avoid blowing up, also known as gambler's ruin, meaning the investor becomes insolvent before a particular investment scenario has a chance to play out. A major factor in managing trades is to hold enough cash to live another day. This brings us to the secondary purpose of the spreadsheet, namely cash management. Warren Buffett refers to cash as financial valium. It allows an investor to sleep well at night. But the safety of cash needs to be balanced with the opportunity cost of holding an excessive amount of it. Ideal stocks to use with the TMS spreadsheet have a pattern of historical price fluctuations that respond well to automated buying on dips and selling on increases. These kinds of stocks are often referred to as equity bonds or franchises or consumer monopolies. They are quality businesses that have high returns on minimal capital with little leverage. The spreadsheet includes sample queries to assist in identifying these kinds of stocks. Once identified, backtesting can be performed to determine optimal price change thresholds. Buying on dips and selling on rips when prices fluctuate is referred to as rebalancing or volatility harvesting or swing trading, or from the currency markets, grid trading. Polaris Trade Management System is best suited for buying on occasional pullbacks. Thus, it is more befitting to call it cycle trading. It was first suggested by Claude Shannon, father of information theory, which is essentially a study of noisy communication channels. Shannon created information theory in the 1940s while working at Bell Labs. And here we see the primary formula associated with measuring channel capacity. Now, on the surface, it seems like a stretch that there is a connection between information theory and investing. In the late 1950s, a Bell Labs cohort, John Kelly, extended Shannon's information theory ideas to create the Kelly Criterion. It computes the optimal percent of wealth to wager on repeated bets to earn a particular return. It limits the potential prudent return. The Kelly Criterion assumes odds of success are derived from well-founded beliefs based on unique insights. Kelly referred to unique insights as a private wire. A private wire emboldens an investor. This is exemplified in the 1973 movie The Sting, in which the central character, named Kelly, swindles a wealthy gambler using a delayed private wire. Like sending a message at a channel's bandwidth with little chance of error, a gambler could compound wealth at a certain maximum rate with little chance of ruin. Inspired by Kelly's work, Shannon revealed a portfolio rebalancing investment approach at a Bell Labs workshop in 1971. Ed Thorpe, MIT mathematician and card-counting blackjack player, continues to use Kelly and Shannon approaches in gambling and managing his hedge fund. Let's take a closer look at Shannon's suggested stock investment approach. Shannon constructed a simple scenario to gauge the upper limit of persistently rebalancing a portfolio consisting of a single stock and cash. Shannon assumed the stock price moderately fluctuates in a repeating pattern while trending slightly upward. Also, he assumed the investor has perfect price movement insight for each period, resulting in changing percentages of wealth invested each period. For periods of positive expectations, all the investor's wealth is invested in stock. For periods of negative expectations, all the investor's wealth is kept in cash. In the graph, buy points are shown as red dots, and sell points are shown as green dots. Buys and sells are triggered based on elapsed time, namely 1 month. Triggers automate the buying and selling. Now, on the surface, this may look like a simple buy low, sell high technique. It is, but it also results in more shares being bought on each subsequent buy. The example is shown in the graph. After 1 year, the investor's return is 63%. If the investor had just bought and held the same number of shares all year, the return is 6.3%. This large difference in return is from the investor consistently rebalancing their portfolio every month. This invests substantial gains while avoiding losses. Shannon's scenario utilizes the repeating scaling bets component of the Kelly criterion. Now, in reality, optimal buy-sell triggers are unknown. Investors do not have perfect insight, and prices do not follow repeating patterns. As this graph of prices of a real stock show, prices tend to swing wildly, particularly in the short term, as investors frequently descend into irrationality as a reflective, adaptive response to conflicting information and misinformation. Unfortunately, there is little record of Shannon continuing to evolve his investment ideas, likely because he developed dementia at an early age. Ed Thorpe, on the other hand, devised a formula to calculate the percent of wealth to invest based on monthly expected stock price mean and variance parameters. To counter parameter uncertainty, the computed percent of wealth is often arbitrarily halved, rendering his formula highly suspect. Shannon's investment legacy is his demonstration of using persistent rebalancing for stocks whose prices moderately fluctuate while trending slightly upward. His approach serves as an idealistic model to compare with candidate stocks. To implement Kelly criterion type balancing in the real world, percent of wealth to invest must account for an investor not having perfect insight. Buy-sell triggers must account for much more than just elapsed time. And prices must be actual market prices, which are uncertain, particularly in the short term. Later in this video, maximize return on the Portfolio Analyzer worksheet will be used to determine these values. Kelly and Shannon approaches maximize the geometric return by rebalancing repeatedly. This is different than portfolio diversification rebalancing. Some economists, notably Paul Samuelson from MIT, have taken exception to these approaches, arguing investors maximize utility, not geometric return. This implies investors do not stay invested, rather they occasionally withdraw cash to live their lives. This reinforces the importance of allocating dedicated funds that remain fully invested during challenging times. For an entertaining account of the controversy, read the book Fortune's Formula. Towards the end of the book, the author writes that it is numinous that there is a link between information theory and stock investing. Now keep in mind, besides Shannon's investment approach not being universally accepted by economists, when using it, it is assumed favorable historical price trends continue into the future. This is far from certain. In order to be reasonably certain, statisticians require as many as 370 trials. This is impossible in investing, which often leads to overfitting an investment model to limited past data. So when applying an investment model, it is best to use the past as a guideline and incorporate the investor's unique insights about the future. It is crucial that stocks be meticulously selected, focusing on diversified, low-risk, stable stocks with positive outlook. So in summary, the primary purpose of the spreadsheet is trade management. The secondary purpose is cash management. Next, I'm going to discuss how you get the spreadsheet. You go to PolarisInvesting.com website and either take the Dropbox link here at the top or scroll down on the welcome page and click on download. Either way, you'll be taking the same Dropbox location. Next, select Trade Management System folder. After that, select the spreadsheet, and you'll see the same Dropbox worksheet as you see here in the spreadsheet that's currently open. It gives you specific instructions on how to download the spreadsheet. Okay, next we're going to discuss the navigation and use of the spreadsheet. A typical place to start is on the Portfolio Analyzer worksheet. I want to point out that on any of the worksheets, a cell with a gray background, either a light gray or a dark gray background, indicates a cell that takes user input. So here on the Portfolio Analyzer worksheet, typically the first values that a user thinks about entering are here in cells D1 and D2 and in S1 and S2. These values are collectively referred to as thresholds or limits, sometimes referred to as guardrails or even trigger points. Let's look at the two different sets of thresholds separately. One set is this cumulative price changes, cells D1 and D2. D1 is a decrease percent and D2 is an increase percent. Decrease percent is a trigger point resulting in buying stock. Increase percent is a trigger point resulting in selling the stock. Cash rebalance thresholds, namely S1 and S2, indicate how much cash to maintain when buying or selling when a trigger point is reached. S1 is a percentage to maintain when buying the stock. S2 is a percentage to maintain when selling the stock. Each one of these sets of thresholds operate under different modes. Cumulative price change modes are standard, scaled, or off, and is set in cell C2. Scaled results in a unique set of thresholds for each ticker, whereas standard results in thresholds that are same for all tickers. The majority of the time, the mode is set to standard. Cash rebalance mode can either be wealth or order and is set in cell R1. Wealth mode, the thresholds reflect cash as a percentage of wealth. Order mode, the thresholds reflect cash or stock value percentages depending on if the order is a buy or a sell. Note, in the wealth mode, it protects against gambler's ruin, whereas in order mode, it's possible it can lead to insolvency, which means zero cash as a result of chasing a falling stock. Next, we're going to walk through how these thresholds are used on the ticker worksheets. Cumulative price changes, both decrease and increase, are shown here, cells X1 and X2, and the mode is shown here as standard. The cash rebalance limits are shown over here, and the mode is here. Now, what's currently being shown on this ticker worksheet is price history dating back to January 5th of 2018, and then the weekly prices all the way up to the current date. If we look more closely at a specific row, we can see here when it first starts off, the initial balance that's brought over from the Portfolio Analyzer worksheet. The initial order is always assumed to be a buy. Therefore, we use this percent here in the wealth mode that tells us what is the minimum that cash balance can drop to when doing a buy. Well, if we start off with $1,000 and we say that cash can drop to 25% of wealth, then cash drops to $250 and the remaining is used to buy stock. Now that there's an order that has been placed, the cumulative price change since that order is now tracked here in column W. So you can see here the next week, stock goes down by 0.8%. So the cumulative price change since the previous completed order is minus 0.8%. The following week, it goes up 4.3% from the preceding week. So the cumulative change since the last order is 3.5%. Well, the limit we have to sell is if the stock goes up 7%, but if the stock were to go down 3%, we would buy. So in the following week, it goes up 17.7% one week for a cumulative change since the last order of 21.9%, which exceeds this higher threshold of 7%, so we sell. When selling, the upper limit is used of 75%. So it says, do not allow cash to accumulate to be more than 75% of wealth. So it looks at the wealth based on the current stock price, takes 75% of that, and then sells enough stocks such that the cash balance is 75% of total wealth. So that means the amount of remaining stock is that, and so we end up selling that many shares. All right, so the next week, the stock goes down 6.5% since the previous week. Well, the cumulative price change since the last completed order, which is just the previous week, is now 6.5%, which drops below the -3% threshold. So a buy is done. 25% of wealth puts the cash balance here. So this much stock value, therefore this much stock is bought back. The next week, we have another drop of 3.4%. So the cumulative price change since the previous completed order drops below the threshold again of -3%. But this time, the amount to buy, we just don't have enough cash really to buy a significant amount to make it worth doing the actual transaction. So it shows that if you were to buy 0.06 shares, it would drop the cash balance by $7.21. But the suggestion in the order column is a buy, but it says NSF, which means non-sufficient funds, which implies don't execute the order. Now, if the user decides to go ahead and execute the order, they would just leave everything the way it is and buy 0.06 shares. But if it was going to do as suggested because of non-sufficient funds, the user would come over in this override column and select to cancel the order. And that does propagate through what we had down through the weeks because of it does change the cash balance. So now we go to the subsequent week, and there is a price change of 6.6%, which is not enough to cause a sell. And then it following week after that only raises 0.1, then it drops by 0.3.1, and then it raises again by 3.7, and then finally we have a cumulative change since the last order. And since we canceled the buy, that goes down as a completed order. It's just canceled. And so we've had a 7.2% change since that last order. And so then we do a sell. Instead of canceling the buy order back on this previous date, the user has other options. And if the user would have selected defer the buy, well, then what we see is that the cumulative price change keeps running. It doesn't reset because a defer is not considered a completed order. So now when we have subsequent changes in the weeks, those cumulative changes are kept track of. And now we don't have a threshold passed until we get to this week of March 23rd. And that's because the very next week, the stock went up 6.6%. So the previous week, we had a cumulative price change of -3.4, but now it goes up 6.6. So now the cumulative change is 3%, which doesn't drop below or above either one of the limits. So we keep running from week to week, and it doesn't pass one of those thresholds until several weeks later. Next, going to look at the impact of changing the cumulative price mode and also the cash rebalance mode. First, cumulative price mode, if we change that from standard to scaled, see the font here in column X changes colors to reflect it no longer in standard mode. And you see that the lower and upper limits have been changed. The limits are changed by using these two values here in column AF. The first value is the investor's expected rate of return, and the other value is the capital asset pricing model's equilibrium return. And if the investor's return is higher than the equilibrium return, then the upper limit is increased, and the lower limit is not as low as it was before in those formulas. Are in cells U1 and U2. Now another option is to choose the mode to be off, and you can see here if off, then there are no increase or decrease limits. The user simply records a buy or a sell in column S. Off is rarely chosen, and scaled is rarely chosen. It's typically set to standard. It's more common to change the cash rebalance mode than it is the cumulative price change modes. Let's change it from wealth to order. Now, when in the order mode, these cash rebalance thresholds have a different meaning. So instead of, like in the wealth mode, where those thresholds had to do with a percent of wealth, the thresholds now had to do with a percent of cash if you're buying, or a percent of stock value if you're selling. So again, instead of just being a percent of that column, now it's either a percent if you're buying, it's a percent of cash, and if you're selling, it's a percent of stock value. So here in the order mode, the interpretation of this 25% threshold means that when buying stock, the current cash balance is allowed to drop to 25% of its current balance. That means 75% of its current balance is used to purchase stock. This other threshold means when selling stock, the current stock value is allowed to drop to 75%. That means 25% of the current stock value is sold. All right, let's go through a couple of orders to make sure you understand how this mode works. Just like in the wealth mode, the first order is assumed to be a buy. In this example, we have $1,000 initially seeded into this ticker. We'll draw down to 25% of the initial cash to buy stock. So that means 75% of this cash balance when we start is going to be used to buy stock. The remaining 25% stays in cash. So we purchase 7.42 shares at the current stock price. And we look at the cumulative price change week to week, and it's not till 3 weeks into it that we see a cumulative price change that exceeds 7%. So that triggers a sell, and when we sell, we keep the stock value at 75%. So that means we sell 25% of the value. And that's why we see the value drop, and then more cash appears in the cash balance. Next week, the stock drops 6.5%, so this threshold of minus 3% is hit, so it triggers a buy. And when we buy this amount, 25% says we keep 25% of the available cash balance. So 25% of 478 is 119. So that means the difference between that is used to buy additional stock. So we see the stock value go up. Subsequent week, drop of 3.4% triggers another buy, and with the available cash balance of $119, keep 25% of that around and use the other 75% to buy additional stock. And you can see here in the cash balance column that in this mode, cash can drop to extremely low levels, like here, dropping to almost zero. And that's because every time you do a buy, you're using 75% of the available cash balance towards the purchase. So if you do enough buying, you will eventually draw it down close to zero. Whereas in the other mode, namely the wealth mode, your cash balance is never allowed to drop below 25% of total wealth. You see in this mode, cash never gets close to zero, and that's why it's said that the wealth mode is good for preventing gambler's ruin, whereas the order mode can drive you towards insolvency if stock price continues to drop. So if you are chasing dropping stock by buying more and more of it as it falls, you'll end up with no cash balance. You'll have little stock value. For the rest of the discussion, we're going to operate in the wealth mode. As mentioned earlier, any cells that have gray background, either light gray or dark gray, can have user entries in them. So let's look at some examples of making user entries. So here in column P, which has these thresholds, you can actually change the thresholds down here. So let's say that a couple weeks into it, you'd like to change the sell threshold from 75% maybe up to 80%. This order and subsequent orders will use the 80% when selling stock. If you come up here and change this 25, you'll see you get a message, and it's telling you that it is odd to make a change that precedes an existing change. So it's telling you that if you make a change here, it will remove any subsequent changes. So if I put yes, you'll see here that it goes back to what the values were, and then if I change the value in this cell, so let's say 30%, we see that those changes take effect immediately and apply to subsequent orders. Changes made in column X apply to subsequent orders, but not the current order. If you make a change, say it changes threshold from 7% to 8%, the threshold takes effect in subsequent orders, but not here in this order where the change is made. If you change a cell in column A0, mode to order, that takes effect immediately. Comment, you can make a comment associated with any week. You can add or subtract cash in any week through using column AG. For example, this week had $400, and you can see here that the cash balance in that week goes up by $400. If you were to add or subtract cash in a week in which there's an order, then the cash balance is changed first, and then the order is applied. Any cell in column S can contain a user entry. So let's take an example. This week here, there's no existing order. If I click on S cell in that row for that week, you can see here that I can choose to manually include a buy, even though a threshold hasn't been reached. I can click it again and do a sell. So regardless of the thresholds, can manually cause a buy or a sell to occur in a week that doesn't even have a trigger event occurring. In weeks where a trigger has gone off, you can decide, click on the corresponding cell on column S, and you can select you want to defer the sell, which means that the cumulative price change continues to accumulate, or I can do a cancel, which means you're just not going to do the sell at all, and then the cumulative price change starts over. And you could switch to a buy. I want to change attention to this cell D2 that's labeled execute. If you select execute, you get a message that says, it's really not necessary for you to select this cell, but if you do, it results in price data being retrieved from the Polaris SQL Server database. But typically that pricing information is already up to date, so you don't see any new prices being brought into the Ticker Worksheet. The other thing it does when you hit execute is it goes to the Portfolio Analyzer worksheet and it copies over values that are in the gray, like these thresholds here, and then the cash balance mode, and in the cumulative price change mode. And it copies those to locations here, 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 and here. After the threshold values are copied over, then the worksheet is calculated. So instead of having cells linked back to the Portfolio Analyzer worksheet through formulas, the worksheets are updated in this fashion. This allows the calculation on Ticker Worksheets to be controlled. The way the worksheets are typically calculated is here from the Portfolio Analyzer. The user selects execute, and part of what it does is it walks through each Ticker Worksheet selecting cell D2. The key results calculated are shown up here in cell F1, H1, K1, and L1. F1 and H1 have to do with if an investor were to just have a buy and hold strategy. They buy the stock at $101.11, and then at the end here, years later, in this case, we see the stock price is $125, and it determines the annualized return over that period, and that's what this number represents. 35.1% is the standard deviation of these weekly returns over that period. That is compared to all this rebalancing that goes on over here in between the stock value and the cash value and the annualized return, and then the standard deviation return change are shown here. This value here in yellow, this is the dividend yield. So when you're looking at an annualized return from capital appreciation, just want to also keep in mind you're getting, at least in this case with this ticker, a dividend yield. And then down here in yellow, this number in F1 is just repeated, indicating that in this graph we're looking at the buy and hold return. And then this number is repeated from up here, indicating that this graph is the rebalance return. So what you have here is a view of what the impact is of rebalancing week to week. If you don't rebalance for this ticker, you get a 5.6% annual return with a standard deviation of 35.1%. Whereas if you rebalance, you get a 3.4% return with a 23.3% standard deviation. So that's essentially return versus the risk, and then the investor can make a decision whether the trade-off worth it to them or not. Another thing I want to make sure you're aware of here on the ticker worksheet is up here in cell AC2 you can select what you want to see in the bottom graph. And if I wanted to show the buys, namely here like in this week of February 2nd, had another buy here in red, and the graph will now show all your buys. If change it to show sell, it'll now show you all the price points that sells were performed at. Now it's kind of busy. You can also do show both, or you can just return it back to hiding both all the time. But typically you have this value set to seed, which means that whatever the value is set to on Portfolio Worksheet here will apply to all the ticker worksheets. Another graphing related user entry is over here in G2. It's referred to as the comparison ticker, and typically it's set to S&P 500. So that's the orange line in both the top and bottom graphs. But if the user wanted to compare current ticker to some other ticker, simply select the ticker, and now the orange line represents that other ticker. Now, background cell does turn red to indicate that that's a little bit unusual to have that setting. It's typically set to S&P 500. Now, if we look at the other ticker worksheets, we'll see that they're all laid out exactly the same. I'm going to hide the ticker worksheets all except the one I've been discussing. Next, we're going to talk about the Portfolio Worksheet. You can see here it's laid out similarly to a ticker worksheet. One of the differences is here in column R, instead of what we saw on the ticker worksheet, listing individual orders. On the Portfolio Worksheet, column R lists the number of orders across the ticker worksheets. And then for each week, it sums up the total cash value across all the tickers, total stock value, and then adds those together and gets the total wealth, and then calculates the rebalance return from week to week. And then it also calculates stock value across all the tickers, and then calculates a return portfolio level. And then the summary information up here tells you how the buy and hold portfolio return compares to a rebalance portfolio return, and then the standard deviation, the buy and hold portfolio versus the rebalance portfolio. Next is the Portfolio Analyzer worksheet, and it's a summary worksheet taking information from the portfolio and each of the ticker worksheet. For instance, up here is the return from holding the stocks to make a portfolio, and rebalance portfolio return. And then for each ticker making up the portfolio, same values are displayed. The standard deviation values are displayed here, and then the dividend yields here. Other information includes the number of orders on each ticker worksheet, and then for each ticker worksheet is a hyperlink here that takes you to the last row on the worksheet. Here you have what's called the coefficient of variance, which is a measure of risk per return for both the hold and the rebalance scenarios. So for instance, here you have with the stock AbbVie a standard deviation of 6.2 per 1 unit of return, and when you rebalance it's 6.8 standard deviations per 1 unit of return. The next several columns have to do with pricing information, the lowest price during the time frame we're looking at, the average price, the high price, the percent between high and low, and then a percent difference between the start price and the last price. Here is the start price, the last price, and then it shows even the current price. Now the dates of the start price and the last price have to do with what user types in an H2 and an I2. You can see here that H2 is currently blank, so what it uses is 5 years previous to the last time the spreadsheet was opened. And since there's only 3.9 years of historical data currently available in the Polaris backend database, it backs it up 3.9 years to January 5th, 2018. And then, like I said, this date is the date that the spreadsheet was last opened. So if we go look at a ticker worksheet, starting date that price data was pulled for is January 5th of 2018, and then it goes down to December 10th, 2021. Right, other information is shown here. I've already discussed the standard deviation between holding and the rebalancing for each ticker and the portfolio. Beta is calculated for each ticker and portfolio, both for the hold scenario and the rebalance scenario. And here it is for the portfolio. Calculation is made to determine the difference in return between holding and rebalancing, and the difference in standard deviation between hold and rebalancing for each ticker and for the portfolio. This column here, we have hyperlinks for each ticker. It takes you to Yahoo to get the current price. In cell AU3, that takes you to Reuters, but it's based on which one of these ticker rows is currently highlighted. In the highlighted row, you just click on a ticker in column A. And now that I've got Kimberly-Clark highlighted, if I take that link labeled company, it'll take me to the Reuters website. To unhighlight a row, click a blank row, like row 14. So remaining data is obtained from the Ticker Worksheet. The data in the Ticker Worksheet is pulled from a back-end SQL Server database. The Ticker Data query is run if the user selects Execute on the Ticker Data Worksheet, but that's not typically how that query is run, because that query is also run when Execute is selected here in A2 on the Portfolio Analyzer worksheet. Now the ticker data query is only run if it's determined that it needs to run. The lower part of the Portfolio Analyzer worksheet is a ticker list staging area. It deals with selecting a ticker list. And here in this area is a place to record previous ticker lists, and then if one, I can even give them a name, like this list of tickers is referred to as the dividend list. Staples, and have two groups of staples. Diversified. You can choose whatever names you want. Now the way that those tickers end up in the upper part of this Portfolio Analyzer worksheet is over here in cell A22. You select one of these ticker lists by choosing the column it resides in. So for example, if I select H, it's going to go out to H, start in row 23, and retrieve up to 10 tickers. And you notice as soon as I select column H, the list of tickers in this area contains an alphabetized list of distinct tickers that are in column H, starting at row 23. Now to move them up into the upper portion of the Portfolio Analyzer, you need to hit Execute. And when you do that, the ticker list is brought up, a query is run against the back-end database, and every ticker that's in that back-end database is returned. And we see the updated list. And also down here in the ticker list staging area, you specify the total portfolio value and then the split of that portfolio value across the tickers. And then when Execute is selected, not only are the tickers moved up, but over here in column R, the investments amounts are also moved up as well. So when you consider the ticker list, the percentage of total investment across the tickers, these thresholds you need to enter, that there's just a lot of values that need to be filled in before the ticker worksheets need to be calculated. So instead of linking the ticker worksheet cells back to the Portfolio Analyzer cells through formulas, the user enters in all the values first and then hits Execute, and then the values are moved over to the ticker worksheets, and then the ticker worksheets are calculated. Now to assist the user in setting these threshold values here, there is a functionality here called Maximize Return, of which you set the upper limits of these values up here and then select Maximize Return, and it'll loop through trying different combinations of these values up to the limits that you set. Now when doing this, it assumes that the user has set these threshold values over here to a level that they're comfortable with. And think of these values over here kind of influencing the swing, how far the cash balance will go down or go back up, depending on buying and selling. These thresholds over here are set the frequency triggers are hit. Now, to fine-tune the way this maximum return feature works, there are several values on the Manage worksheet that can be modified, namely in this area. These two you've already seen, and that is the lower and upper limits that are displayed by default, namely these values here. Other values to tweak include the minimum value to loop through. Right now is set to 0.5%, and then the increments per loop 2.5%. And then this value here will determine whether intermediate results are displayed. Turn that on. The cell's background turns to red because that's not normal, because there is a performance penalty by displaying intermediate results. So let's say a user had previously changed this number to -9%, and maybe even this threshold was set to like -4%. But let's say you want to work off the defaults. You can just select this value here, and now the default settings are restored. All right, let's run the maximize return. Click on the cell. A pop-up appears telling that it's going to run from -8% up to 8% on stepping at 2.5%, and then finishing up at 0.5%. Then some other details about how long it's likely to take. User agrees to that, they select yes. Now, because we have that one condition set there where it's going to show the intermediate results, we're going to see up here as it loops through the changing of the threshold value. Also, you see down here at the bottom of the screen is this a status update that's shown regardless of whether you have that value set on the Manage worksheet to display intermediate results or not. And you can see here this takes quite a bit longer to display those results. So typically you don't display the results up here, you just look at the intermediate results down here in the status bar. And once it completes, it shows the maximum return that it computed, and then what the values were for these threshold values, how long it took, and then the user has a choice to use these values as the current values. So if you select yes, you'll see that the values are now brought up here. Return of 8.3%. Now we just maximized the portfolio rebalance return, but on the Manage worksheet, you can select an alternate cell in that column C to maximize. Namely, you can maximize the rebalance return of a specific ticker. To assist in identifying tickers to be included in a portfolio, a stock screen worksheet is provided. And in the stock screen worksheet, you place a query to the back-end Polaris database and then select A2, and that query is executed, and the result sets is shown starting in row 18. And some values associated with each ticker, and then based on that information decide which tickers you want to include and bring over here to the Portfolio Analyzer worksheet. There is a worksheet here called Sample Queries that cut and paste specific queries over to the stock screen worksheet and run the query. All right, next we're going to talk about two remaining worksheets we haven't discussed up to now, namely RandomWalk and Randomness. Here in RandomWalk, in cell L2, you can select a style or method of randomly selecting price changes week to week. The most straightforward one is called biased, where it means that each week you have a slight tilting in favor of a positive versus a negative. The way it's set now is we have a 52% more likelihood that the price change will be positive versus negative. And then we also have set up that each week, if it's positive, it's a 3% price change. And if it's negative, it's a -3% price change. So week to week, the actual direction of the price changes is randomly selected with a bias towards a little more positive returns than negative. Each time D2 is selected, it re-randomizes the results with the bias still being more positive than negative. So this gives you an idea of kind of a random walk of what kind of returns tend to generate better rebalance returns. For example, this random walk sequence generated a rebalanced return of 6%, whereas just holding the stock generated a 3% return. So if we look over here at the top graph, you can see here that the starting price of $100 and the ending price are fairly close to each other. And in between, you have frequent up and down price movements. This is the ideal scenario that you're looking for. Again, repeated rebalancing is best suited when a beginning and ending price is roughly the same, and there is frequent moderate price changes in between. And this has to do with a geometric return versus an arithmetic return. And if your geometric return, which is what's shown on the blue line, is 0, well, mathematically, your arithmetic return is always larger than the geometric return. If you have a geometric return that's close to 0, then your arithmetic return is going to be greater than 0. So you're going to benefit from rebalancing. This is why back in this Portfolio Analyzer worksheet, this area here is called out because it's showing for each ticker what the difference is between the high and low price and the difference between the first and the last price. The last worksheet to discuss is the Randomness Worksheet. This worksheet is intended to be a place to go and explore randomness and volatility. So start off here in cell D1, you can select a specific ticker that you're interested in this case AbbVie. And then you can come over here and select execute. You'll see here on the graph that every time you select execute, it shows the position of this randomly generated return based on the ticker's calculated annualized standard deviation and annualized mean that comes from the price history from that ticker's worksheet. So in cell D2 is ticker. You can select here in D1 any of the ticker worksheets, including the S&P 500. So it pulls data from the S&P 500 worksheet, and as you hit execute, it shows different randomly generated price returns for the S&P 500. Now, if you come here to D2 and you select S&P 500 history, is the long-term historical standard deviation and mean return of 17% and 10%, not the values from the S&P 500 ticker worksheet. So now as you hit execute over here, you see 5 different returns being generated randomly based on this historical standard deviation and mean. And then in the graph, you're seeing the average return calculated across those 5 years. Now you can change the number of years if you want to change it up to 25 years and now hit execute. You're seeing now an average being displayed over here in the graph. That's a 25-year average return based on historical parameters for the S&P 500. Now what you notice is you change the number of years that the S&P 500 average return is being calculated over. The dispersion of the average return over the period becomes less and less dispersed as you include more and more years in a group. That is shown in this graph below here. When groups consist of a few number of years, let's say 5 years per group, and you have many groups, each time you take a mean of groups of 5 years, you are going to end up with a wide range of means. But if groups consist of 10 years each, the means of those groups are much narrower. And then as you do it all the way up to 25 years, it becomes very narrow. Statisticians refer to this as the central limit theorem, but it also demonstrates mean reversion. Well, let's back up and talk about normal distribution. Back in 1654, Blaise Pascal came up with what's called Pascal's triangle to calculate the coefficients in a binomial formula. Then about 100 years later, mathematician Abraham Demove came up with a continuous formula for approximating large binomial coefficients. And then it wasn't until the 1900s where it was first proposed that normal distribution could be used for stock prices. And then in 1959, an astronomer who had a wide range of interests observed that it is nonsensical to think stock prices are normally distributed because that implies prices can be negative. Rather, stock returns are normally distributed. Later studies showed stock returns are at best somewhat normally distributed. They have occasional fat tails, and this is sometimes referred to as the volatility smile, and that's kind of represented in this bottom right-hand graph where typical returns are normal, but on the extremes you can have more than you would expect with the normal distribution. As you recall, as we were hitting the execute button up here, the randomly generated returns concentrated around the mean of the distribution. But here we show typical returns year to year in the stock market, and they vary widely from the mean, occasionally extremely negative. So the expression in the stock market is that average is not normal. Even though the mean return is 10%, you rarely have a 10% return in a given year. Returns tend to be extreme from one year to the next. When you calculate mean and the standard deviation and apply them to the normal distribution, you end up with a unrealistic distribution curve. So the use of the normal distribution for stock returns is mathematically convenient, but needs to be applied cautiously as it relates to stock returns. One last thing I want to point out on this worksheet is if you're looking at tickers, let's change it to AbbVie. The beta is calculated from the AbbVie worksheet as shown here, along with what's called R squared, the standard deviation, its mean, and then its coefficient of variance. Now if you want to compare that to other tickers, let's compare it here to, let's say, the S&P 500. Well, we'll see that the S&P 500's beta with itself is 1. Its R squared is 1. Standard deviation off the S&P 500 worksheet is 35%. Mean is 5.6, and its coefficient of variance is 1.4. But these two numbers up here show you what's the relationship between AbbVie and the S&P 500, and it shows that its beta relative to the S&P 500 is its beta 0.89, and then the R squared number is the same. Now if we use a different ticker than S&P 500, let's use AbbVie itself. Well, now we'll see that it's got the exact same beta off the AbbVie Ticker Worksheet, same R squared, and then its beta relative to itself is 1, and then the R squared value is 1. So typically, instead of comparing a ticker to itself or the S&P 500, you compare it to one of the other tickers to get an idea of the relationship between this stock, AbbVie, and another stock in your portfolio. If you need a refresher on beta and R squared, see the relevant risk worksheet. Pay close attention to this area here. Now we've been through how to navigate the spreadsheet, do a more holistic view, and go through a scenario of using the spreadsheet. And that usually involves two distinct phases. First phase is selecting tickers for the portfolio. Second phase is trade management, namely executing buy and sell orders. So let's go through the first phase when dealing with selecting tickers for the portfolio. Typically start off in the stock screen worksheet and decide what query makes most sense for what you're trying to accomplish. In this example, I'm going to assume that I'm looking for high-paying dividend stocks. So I'm going to use this dividend aristocrat query. Let's copy it over and now execute the query. Now, first time I execute it, I leave commented out this join with prices proper, but I'm going to now uncomment that. This ensures that the tickers returned from the query have a complete price history, starting on January 1st, 2018 and up through the most recent date that stock prices are available. So then from here, you do some further analysis to decide exactly which of this group of tickers you want to move forward with. Suggested you use the PolarisInvesting.com site to assist with your further analysis. For example, if I want to drill down a little bit more into ConAgra, I could do it here. And there's plenty of other information available on the PolarisInvesting.com website to talk through the use of this website. So let's say you move the sliders around and you finally decide that the rate of return you're going to expect going forward is 9.4%. So what you can do is come out here to Conagra on the Portfolio Analyzer worksheet and enter 9.4% here. And you notice that the background of that cell changes slightly, where it now has a dotted background to indicate that a user has overwritten what's normally there. I'm going to go ahead and go with a specific 10 from this group, and I'm going to refer to it here as my list. Now I'm going to make my list the active list in the portfolio by first selecting the column that my list is in, namely column P, and then selecting A2 to execute. This makes my list tickers active by moving them up into A4 through A13. Well, next I'm going to run maximize return to get the upper and lower limits that worked best historically. Before I do that, I got to decide what historical period I'm going to use while running maximize return. Now the spreadsheet defaults to the last date of a portfolio being the last date that prices are available in the back-end database, and then it backs up the number of years that you designate, in this case 5 years, as the default start of the portfolio date. Now, as stated earlier, the back-end Polaris database only contains stock prices starting on January 1st, 2018. So even though 5 years was requested, only 3.9 years are available, which takes you back to the first date that prices are available. Also need to decide on the values associated with the cash rebalance mode. So I'm going to go ahead and go with the wealth mode, and then 25% of wealth to be maintained when buying stock, and 75% of cash to maintain when selling stock. So now with those values set up, I'm going to now run maximize return. So we start that. Once the maximize return routine is finished, it displays the maximum return and the values it used to calculate that maximum return. And then if you choose to move forward, you select yes, and then it moves those values up into D1, D2, and then recalculates the maximum return based on those values of 6.9%. Now that is a historical number over the preceding 3.9 years. Those would have been the best cumulative price change thresholds to have used, and would have resulted in a portfolio return of 6.9%. Now if we look at individual ticker worksheets, you can see that the buying and the selling that would have been done over the preceding 3.9 years from ticker to ticker that results in this 6.9% portfolio return. If you decide to move forward, then what you do is you would take this date here in I1, because that's the date that reflects the most recent date of which stock prices are available, and you would indicate that as your starting portfolio date. That as weeks to weeks pass by, every time you open up the spreadsheet, the new week would be automatically detected, and you would decide whether you're going to implement the suggested orders in that new week or not. But to show how that works, let's pretend that instead of this happening here on 12/10, we just did this analysis. We did it on 11/19, so a couple weeks ago. And in order to kind of fool the spreadsheet into going back in time, going to go ahead and enter in that the spreadsheet was opened on 11/19/21, and the last available stock price also 11/19/21. So now going back to the Portfolio Analyzer worksheet and selecting Execute, it's going to start up the portfolio on 11/19/21. So for here, For Conagra, it's just one order that we see, namely this initial buy, and that's what we're going to see for every ticker. So we end up with 10 orders across the 10 different tickers. Once the portfolio has initially been set up, it's best to save the spreadsheet with a unique name, something like my portfolio. Okay, let's say a week has gone by. Now you reopen the spreadsheet. You notice that it's in red because the ending portfolio date is now advanced 1 week further. And we can see that here in the Manage tab, that now you open it on 11/26. It goes out and checks the most recent prices available from Polaris, and that's now moved forward a week to 11/26. Next, select Execute. Say, okay, I'm in a new week. Go out there and update the ticker worksheets to reflect this additional week of price data that is now available. You now see there's a total of 16 orders here in column D, whereas the previous week we had 10. And then every cell that's got green here in the background in column D is indicating there's a new order this week that you should be paying attention to. You either can hyperlink to it directly from this cell. We're just going to go look at some of them here by selecting the worksheet. So here you can see here for the Conagra, we've got a cell now here in this week, and then we can decide if we want to go ahead and with the recommended cell, or we can override. Seeing here for this other ticker, got a sell transaction. Going back to Portfolio Analyzer, you can see that we've got a total of six new orders to consider across these 10 tickers for this week. Now let's say you decided here in week 2 that you just prefer to cancel all the sell recommendations. So you can see here, like in this first ticker, we selected cancel the sell. Next ticker we cancel. But for all 6, and they just turned out to be sells this time, just want to cancel sells in the early going. What you can do is either on a local basis per ticker, you can just automate that for now and select that you want to auto cancel sells going forward. Now, if you want to do it globally across all the ticker worksheets, you go to the Portfolio Worksheet and select auto cancel in cell S1. So let's say another week passes and you now open up the spreadsheet. Now we're seeing that we're in the week of 12/3. See that we've got red, meaning we need to update the prices. So next select Execute. Now for each ticker, subsequent week of price data is brought into the spreadsheet. Now you notice in this new week there is no additional orders, but we have auto cancel sell on. So if we go look at individual tickers, now this ticker we don't see any orders being suggested. But here for GIS, we did have a sell. You can see that we auto canceled it. Also auto cancel the sell for Kimberly Clark, and then for this stock as well. Okay, let's say yet another week now has gone by, and now we're in the week of 12/10. But before I hit execute, I'm going to go back and just having all transactions close out like they normally would. Now I'm going to select execute, and price data now is advanced yet another week, and orders automatically added if a buy or sell threshold has been exceeded. You can now see that we have 7 new orders for this week. And we can either, again, hyperlink here, just go look at a couple of them. So like here for Conagra, got a sell. Stock, we got a sell. Again, we have to now manually decide whether we're going to follow through on the sell or not because we've turned off auto action. Now the example that we just went through assumed for each ticker worksheet, when you start out that a buy limit has been hit, and so right off the bat when the portfolio starts up, a buy is done and maintaining the cash balance that's specified. But if you prefer to wait for a buy trigger to be hit subsequent to when the portfolio starts, you can enter in 100% here. And I'm going to go ahead and back out this cancel that we had put in for the previous example. And you can see here that you still have all your available cash here through the first couple of weeks. You're waiting for the next buy trigger to be hit before buy any stock. Now, when that next buy trigger gets hit, you're going to get, just like you did up here with 100%, you're going to get a buy non-sufficient funds. So when that next buy trigger hits, you'll want to set it back from 100% to 25%. Now another option you can do here is, let's bring it back to its default, is you can scale into it. Instead of just having no buy done at the beginning, you could do something like 80% on the first buy, and then for each subsequent buy trigger, you could continue to lower this down to 25%. Since this video was originally recorded, an additional method has been added to postpone the initial buy order by overwriting the buy in column S with a cancel buy. This accomplishes the same thing as temporarily setting the cash percent of wealth to 100%. The advantage is you don't have to remember to flip the cash percent of wealth back to its original value later on. When you cancel the buy, the cumulative price change is reset to 0, and the next order will not occur until a trigger threshold is reached. You can also override with a defer buy, which uses an existing cumulative price change that you set in cell W4. Let's say you set it to minus 1.5%. You see this adds to the cumulative price change. If W4 has a value of 0, then defer buy is equivalent to cancel buy. So keep this method in mind to postpone the initial buy order. As this example demonstrates, success of this trading approach is highly dependent on the stocks you select. Stocks that perform best are those whose past price movements are likely to be similar in the future, with their ending price being around their starting price, with moderate volatility in between. Well, this has been a video on the Polaris Trade Management System TMS spreadsheet. Thanks for watching.